Good morning, everybody. It's great to be here at IMARC. So it's with great pleasure that I get the great opportunity to host the keynote panel discussion. I don't propose doing a monologue to identify all the challenges that we have. I'm hoping we don't get into too much of a doom loop, because a lot of the discussions around critical minerals can identify all the problems that we have. I think the problems that we have are pretty well known. The one thing I will say, though, is that when we talk about critical minerals, and different countries have different critical minerals lists that range from single digit to over 50. And there is very much a focus on rare earths and some of the more esoteric commodities. But the challenge we have around supply chains isn't just about some of these really funky metals that many of us couldn't pronounce the names of 5 or 10 years ago. It relates to basic commodities, aluminium, copper, to name but two. Because if you think about the direction of travel over the last 20, 25 years, we have flatlined at best in terms of our supply chain position. And in many of the commodities, we've actually reduced our self-reliance on those commodities. So, without further ado, I will kick off the questions. Hopefully we can have some constructive disagreement, as opposed to what can happen on panels, which is we all agree with each other. So I'll kick off with Dominic around the geopolitics. So first question, how are shifting geopolitical dynamics, such as resource nationalism and regional blocs, reshaping the way that government and investors look at resource security?
Look, it's a huge challenge. Can everyone hear me? Yeah, we can. Great. The Director Almeida, I thought very eloquently from the Commission, the European Commission, put the statistics. But just to give you a kind of sense of scale, in order to meet our energy, our innovation needs, our net zero aspirations, we would need to invest more in the next 30 years than we have in the last 70,000. So that's just a sense of the scale of the challenge. And against that exponential demand, we've seen concentrated supply. We talk about these figures, but to give you a sense, you asked about the geopolitical fault lines. At the time of the Yom Kippur War in the 1970s, when we had the last really major oil crisis, the top 4 oil producers were between 11 and 26% concentration of the market in terms of dominance of supply. China has 60, 70, 80, if you add in refining, 90% plus concentration. So this is the challenge. You add into this defense requirements. We've seen the AUKUS deal confirmed in Washington overnight. That was something as UK Foreign Secretary that I signed off on. Huge demand for uranium, rare earths, gallium as well. So that's another overlay. And you can see here the elements of a perfect geopolitical storm. We're 20 years behind China. We need that combination of public-private partnerships and friendshoring if we're going to meet the range and the volume that we and our industrial base so sorely need.
And you talk about China's dominance. Is it just about midstream, or is it the full value chain where action needs to be taken?
Well, I think if you look at Chinese increasing dominance, first of all, they've got a really good strategy. Let's not pull our punches. They've got a smart strategy, huge innovation. Of course, they avail themselves of all of the tools of a command economy, and they've been doing it for 20 years. But they're going right the way across the value chain. So refining, processing, but also battery dominance, manufacturing, and wider areas of the industrial base. And you can see this if you look at the trend data. So no, I absolutely, and if you speak to Chinese investors now and ask them what they're buying and what they're procuring, it's pretty much everything. So the ambitions in this space are off the scale. We're well behind, but to avoid the doom loop, counsel of despair, there's lots of things that we can do about it. The capex requirements. I thought the Trump-Albanese deal was fascinating. $3 billion invested from government capital to unlock $50 billion worth of investment. That's the kind of thing we need. better public-private partnerships. Governments are not great at picking winners, but they can pick good public-private partnerships. So at Appian Capital, we've delivered 12 mining projects to fruition since 2016. That's more than the top 5 mining companies combined. So pick your partners well. And then this friend-shoring piece, I think, is super interesting between Australia and the US, but also there's huge space for the Europeans, the Japanese, the Brits and others to do that together. I mean, we've got one asset, Gippsland Critical Minerals in Victoria, that is 7% of global supply of heavy rare earths, which matched against that dominance, that concentration of a 90% that China has. You can see why, working with the US and with others, that is a real source not just of investment in Australia and in Victoria, but actually a global game changer.
Great, okay. And you mentioned Europe and obviously Europe's key vulnerabilities. So Massimo, it'd be useful to identify what the vulnerabilities are in terms of securing the raw materials and how you see international partnerships trying to bridge the gap between where we are and where we need to be.
Absolutely. Is it working?
No? No. I can only apologize for the technical glitch.
Okay, we're playing musical chairs with the microphone. So the first vulnerability is in the processing and in the refining, of course. Contrary to common opinion, Europe does have some significant mineral deposits. Of course, there's a lot of them of very different types in the Scandinavian region. So I'm looking at Norway, Finland, and Sweden. In the Iberian Peninsula, there are some fantastic deposits of many critical materials. And of course, in the Balkan regions, which is not EU, but is still Europe, the deposits are there, but the real weakness is in the processing and refining. And this is a tragic event in a way, because Europe used to have the leadership in some of the refining and processing in the past. Thinking about rare earths, for example, the techniques for separating rare earths on a commercial scale were actually developed in France back in the 50s and 60s. But all that expertise has been lost over time. So that's definitely one of the vulnerabilities, the refining and the processing. I would say the main vulnerability is in the lack of courage. Europe doesn't really have a culture of investing into mining and into the resources. I was having a conversation with Demus yesterday, and we were thinking about the old equation. Whenever you have 1,000 potential strikes, you end up with exploration. You end up with around 100 that are potentially prospective. Out of those 100, you end up with 10 that are potential mines, and out of those, you end up with one actual mine that is developed. It takes a lot of courage to develop a mine, to develop a process around critical raw materials. And of course, if I went to Nicola and asked her for a loan to develop one of those 1,000 prospective deposits, she would look at me in a very funny way, and she would say, hey, the risk is too high, we cannot do this. But we have to do it. We have to invest into exploration, mining, processing, and recycling, of course, to be able to produce these materials. Otherwise, we'll never get there. And that takes a lot of courage. So European institutions need to get into a little bit more of a gambling mentality and be ready to invest, be ready to recognize that sometimes the investment will not pay off. The third point is a certain lack of cohesion that exists among different member states, and also among different companies within Europe. We still haven't really understood that we need to work together to be an important player in the international arena. And the fourth one is we need to work on the skills and on the innovation. When you look at the most important papers that are published in mineral processing, mining processing, new exploration techniques, these are all coming from non-European, non-Western world countries. And that means that all these innovation that is being developed now will be the new mineral processing techniques, the new mining techniques that will be developed in the future. So we need to become more competitive when it comes to innovation, We need to become more competitive when it comes to producing the right skills in the right numbers to sustain the growth of the minerals industry. International partnerships can help in all of them, of course, by providing an opportunity to spot notes, to understand what the rest of the world is doing, to learn from what others are doing, and to share knowledge in all the points that I mentioned before.
And so you're looking for Europe to become less risk averse? To lean into something that is arguably quite a risky prospect? So is it all about governments providing funding?
It's not only from the point of view of the government providing funding. Of course, that is a necessary step. That is something that needs to happen at this point in time. We are in a situation where I think we need a circuit breaker, we need a trigger to get things going. And I think that government intervention at various levels, both at the level of the EU, but also at the level of the member states, is a necessary step at this point in time. We can argue whether that's desirable or not, but I think that is one way of breaking the circuit. But also we need more courage from the point of view of industries and being more ready to work with each other instead of competing with each other, which sometimes happen in a way that might not be very healthy. Also a lot more courage from the point of view of the end users. At the end of the day, we are buying these products, we are paying taxes for these funds to be deployed in this way, and we need to make the effort of having a better understanding of the whole industry and of the whole value chain. And I think we are still far from that point. Most people still don't realize what is the link between the minerals industry and the products that we use on an everyday scale. So there needs to be more courage from all parties involved.
And Nicola, I'd love to get your perspective on the EIB's role in financing something that many banks choose to shy away from. A sector that is risky, getting riskier. We're going to have to start mining in jurisdictions that hitherto we've not wanted to because of risk. So how do you price that risk? How do you deal with that?
When it comes, now I think it's not. This is now working. Okay. I think this is a test, no? But when you can come across with these mics, then you also can come across with all the questions and challenges we have around raw materials, I think. So when it comes to European Investment Bank Group, and we are acting as a bank together with our daughter subsidiary, which is the European Investment Fund, when it comes to the equity side, we are not shying away, not at all. So I often also translate EIB as enabling innovation bank, because what we really want to do is to push innovation when it comes to critical minerals or in other sectors, but especially in critical minerals. I think we together, especially as Australians and Europeans, we can prove that mining, processing, refining can come together with clean tech, so that we do it in a very responsible way, not only when it comes to working conditions, but also for environmental question. And it was mentioned by some of the Australian ministers before, and I see our understanding here also with your board. So for us, this is something we want really to support. We go for innovation, first kind of the art. We are capable to take risks with the firepower of a balance sheet of 600 billion, and we are able to invest up to 100 billion per year. And as it was mentioned that it has to be leveraged, of course, you do not use it one per one. We are a crowding in bank. We go up to 50% and have an average leverage of a multiplier by 5. When it comes to the mandates out of the European budget, it is even 1 to 15. So we use our capital very, very efficiently to go for the right projects. What are the right projects? We are now as a bank implementing, was already mentioned by Joachim, what is the regulation in Europe for all the 27 member states. So the 27 are aligned, even having 27 different governments, 27 different parliaments. They aligned all over the whole continent with this regulation, which gives the framework for investment, and we are now implementing this investment. For example, here in Australia, you just signed last year, the government of Australia, the European Union as a total, the strategic partnerships for critical minerals. We are now here with a huge delegation, having corporates on board, having the politicians on board to implement this in investments. So we are looking for investments here, as we are looking for partnership investments of Australians, especially Australian companies in Europe. And I can tell you, as a bank, we have already a lot of Australian clients which are realizing investments in the European continent, different member states, when it comes to mining, when it comes to processing and refining. We are going for the whole value chain, so really from the first idea of looking for resources up on mining, refining, but also recycling, and when it comes to innovation, so substitution, so that we also develop new materials. And this is also a thing we can do for corporates on the whole life cycle, so from the first idea up to IPO and beyond.
So an area where China has been incredibly successful is full value chain, not being too concerned about every part of the value chain hitting its numbers in terms of returns. How do you cope with that? Because you've mentioned refining, smelting. There's a good reason why we've shied away from developing refining and smelting in certain areas, because it doesn't make money. It doesn't provide the returns. So how does the bank cope with that? How does it deal with it?
I think you have to have a plan, a strategy all over the whole value chain. So you have to bring together the different steps, because you know at the end you will not end up in your industry with the materials they need if you are not having a look on the whole value chain. So this doesn't mean that you have to have them all in the same spot, but I think you have to have them in a trustworthy and reliable partnership. And here maybe in times where the whole world seems to be flipping around every day, maybe sometimes from tweet to tweet, there is a new currency, and this is reliability and predictability. And I think here Australia and the European Union and Australia are a perfect fit because we share the same values. We are not changing our plans every day or every week, 180% around, but we have a common strategy forward. And this is, in my opinion, a win-win partnership. And I even would go so far to bring other third countries on board so that we really stabilize the region and reach out for a stabilized region and club of friends who is playing by the rules when it comes to raw materials.
Sure. So we've heard from Dom about the geopolitics. We've heard a bit of a European perspective. We've heard finance. So Mark, you're at the sharp end, actually delivering these commodities to customers. So what appetite are you seeing for supply chain security? From your perspective, what does that look like?
Yes, thank you. Yeah, I'm sitting here somewhat chuckling to myself because today Traxys has already traded 10 of the critical minerals, buying them, selling them, supporting our customer base. So we're active in the entire list and trade all of these products really on a daily basis. We've been clamoring for government awareness. You know, when you have a problem, you solve it by first becoming aware of the problem. We started talking about what the Chinese were so successfully doing 20 years ago in taking the whole value chain and creating pinch points where they could basically become champions with their 10-year capital return models, combating a 90-day Western capital return, where the CEO running a company could not afford to operate at a loss for long enough because he was ousted. So we've got a fundamental problem with the duration of capital investment. We then also have a problem with the cost of capital. The Chinese have been very effectively subsidizing industry with very cheap money. 5% debt doesn't compare with 2% debt. So we need to effectively come up with the right structures. And I think that's starting. That awareness is finally beginning. The way I think about it is, let's take what the Chinese have done so effectively to build that entire supply chain. And we had it in Europe, we had it in the United States 50 years ago. It's one of the reasons we were so successful in the industrialization process. The Chinese have taken on that model and done it very effectively. So what do we do to solve the problem? I think there's three things we need to focus on. One is near-term stockpiling of critical products so that in the event of a disruption of supply, like we're seeing right now in certain products, product is available for industrial users to consume that product. And that's going to vary by country, from country to country, by region, by trade bloc friendly region to region. Next piece of the equation is the availability of capital and government support for protection of industries to start the restart of brownfield projects that have been sitting idle for decades, that have the infrastructure with the right capital investment, that have been permitted historically and can update permits again. Permitting is a big part of the government equation. If it takes you 7 years to permit a project in Australia or the United States or Western Europe, and you can do it in 18 months in China, that is not an effective tool. Governments have to get behind supporting permitting process to accelerate capital investment and ultimately the return on that investment. But I see brownfield redevelopment, redeployment of assets as the medium-term solution where product could be flowing in 18 to 24 months if it's fast-tracked. And last but not least is trade bloc friendly production assets. And I think that comes from an integration between trade blocs that are friendly, that want to collaborate and operate together. We've seen announcements of this recently, which is very encouraging. Raw materials are bounded by the geography and where they occur in the Earth's crust in exploitable concentrations. So you need to have areas cooperate that can then bring the whole value chain to bear. So it's about the cost of capital, capital formation with the appropriate returns, government oversight to provide the protections needed while an industry redevelops and deploys that capital, and ultimately that's a public-private partnership that I, for the first time in 15 years, see the kernels and the seeds and the willingness and the awareness to execute on this. So I'm very excited about the possibilities to address these problems.
And you talked about stockpiling. Obviously, it's du jour to think about price floors, guaranteed pricing. As a free marketeer, how does that square with the volatilities that traders love and thrive upon?
Yeah, listen, we love market volatility. It creates opportunity, dislocation, also creates opportunity, but we also don't like to see our customers and suppliers going out of business. So I think you need the appropriate level of government protection to start industries. The industries that we bring to bear have to be collectively profitable and in the lower quartile of the production cost curve if possible. So they have to make sense. So you need smart people thinking about the projects, but then you do need the government support. The Chinese have supported their industrial champions for years. So this is not something that the winners haven't been doing. It's something we need to do selectively, and then it will be, I think, successful ultimately.
Okay. And Demus, obviously Australia, the land of plenty in terms of what's in the ground, historically, and indeed currently a significant processor of materials. And to Mark's point about wanting to have partnerships with operators sitting at the lower end of the cost curve, that happens at the mine level, but not necessarily at the processing level. So where does Australia fit in terms of the geopolitics, the economics?
I don't think this is working. Hello?
We'll get there in the end.
No,
Can I start keying off an earlier comment on courage? Yes, there's courage in significant capital investments in a financial risk environment. But in Australia, mining has been undertaken for over 100 years now, mining and mineral exports. And central to the success of Australian mining has been an amazing geology in Australia, and that's quite clear. Australian mining has built its reputation through the ability to export, mine efficiently and export to customers, and I'll touch on that a little more. But they've done that and grown as a global leading mining industry based on that 100 years of activity. The efficiency that they've been able to extract, the way that they've undertaken business, the reliability of supply, the strong mining and processing capability has led to good ESG practices, protecting that reputation as they've gone from domestic producers to global miners and processors. So that's the first thing. The second thing is building trusted relationships with partners. And if you think about, for example, some of the Asian economies, Korea, Japan, they have relied on the imports of things that they need for their economic activity. And they've built a strong relationship over many, many decades with Australian mining to do that, to the point where both Australian mining and the economies in Asia see a symbiotic relationship, one in which it's not just about mining and processing material, it's about fine-tuning that material to suit the customer's needs, the partner's needs. And it's that's formed the platform for a strategic partnership between Japan and Australian mining in the supply chain for rare earths, for example, one that protects both the supplier and the demander and all of the links in that supply chain. The relationships that have developed continue to develop. It shows what can be done when there's a recognition of a symbiotic relationship, a cooperation. And one of the things that we have seen come out of both iron ore, bulks, and other commodities, as well as rare earths, is how do we work together to ensure that operations at the mining end and along the processing to the final product are tuned to deliver the best possible outcome. That's a cooperation. What we see is the opportunity to build those supply chains based on trade and open markets, which has been a hallmark of the Australian economy for a long time, and to build on that with new strategic partners, to look at how we can work with Europe, how we can work with the US, how we can work with the emerging economies in Southeast Asia, and our existing partners to really look at supply chain security and economic partnership through to the future in terms of also in terms of ESG and renewable energy and climate mitigation needs. So where to from a partnership perspective? Obviously, every economy is going to have a different slant on what a strategic partnership looks like. That's absolutely fine. The more important piece is how do you work together to secure a supply chain and share the benefits of working on the efficiency of that supply chain and the reliability of the supply to both customers and the reliability of demand to those miners and processors that are really looking at higher costs with narrow supply chains and the opportunity to develop the next round of mines necessary in much more challenging global circumstances.
And historically, Australia has provided a lot of mine supply to the world. And I mentioned in my perhaps not so brief intro around the midstream processing that has flatlined, stroke declined. Do you see a reversal of that with partnerships? I mean, how does Australia address something that isn't just Australia's problem, it's a Western problem, and that is high operating costs? We don't sit in the lowest quartile of the cost curve in terms of processing. And without access to cheap energy and cheap finance, it's going to remain that case. So I'd love to get your perspective on that.
If markets are not operating in an efficient market and economic framework, if there are things that are driving price in one direction or another, there are challenges from both a supply end and a demand end perspective. If the price goes too high, then the demand end industries are not going to be able to survive economically, commercially. If someone undercuts the price of a commodity or raw material, it will make it difficult for mining companies to develop the next round of mines needed to supply that. So the question of a strategic partnership is, how do you ensure that you work with your customer to ensure that the viability and longevity of each end of that supply chain can be sustained, where the price isn't so high that it drives the customer into a situation that is financially unviable, or too low that it doesn't enable mining and processing to go ahead. It's a balance question. Now there is then the question of, well, okay, how high is too high? What about the opportunities for broader supply chains that start to pick up emerging economies, Southeast Asian economies with comparative advantage, being a way of reducing the overall cost of the processing? How do we work together to share those advantages and build a secure supply chain through multiple partners? Some may not want to. Some at a government level may want to go government to government, economy to economy. Others may look at opportunities to reduce the cost by bringing in other partners with economic advantage. Both should be seen as mechanisms where supply chain security is delivered through strategic partnerships.
Okay. We've talked a little bit about the need for public-private partnerships. And Dominic, I'd like to turn to you now. PE hasn't historically been the lowest cost of capital, the lowest opportunity cost of financing. How do you see balancing risk and returns from a PE perspective? So with Appian.
That's a very big question, but I think in the end, what you're looking for is patient capital. And I mean, you touched on it earlier. Patient capital can ride out short-term fluctuations in the market. I think it's a bigger challenge when it's outright price manipulation. We talk a lot about permitting. I had the privilege and misfortune of being housing minister in the UK, which does the permitting process, there must be a way with high ESG standards where we can reduce the time frames for critical national infrastructure like this. And there must be a way with high standards but giving reasonable investor certainty to mining projects that we can expedite that process. I think the other thing, and I think it was touched on there, you know, when we talk to everyone, they want to go up the value chain. They want to do the refining, the processing, maybe even some of the recycling. In the end, we should onshore when we can. So I'm thinking of the US, our European partners, Australia. But we also need to recognize with permitting how it is, with high energy costs, that we're going to need to friendshore when we must. And that is, I think, one of the interesting pieces. We just heard from the Saudi minister, there's huge appetite in the Gulf. So one of the challenges for the US, Australia, our European partners as well, is how do we reach out for those high trust partners beyond our comfort zone? So we're thinking of Peru maybe, Philippines, Saudi, possibly Indonesia. There's been challenges there in the past. But if you want to break this deadlock, take rare earths. The US is not going to provide its own rare earths needs. As I mentioned, we've got Gippsland Critical Minerals here in Victoria. But if you take 37% of global supply of rare earths, you're looking at Brazil and Vietnam. Those are two typically non-aligned countries, but with great opportunities there. Can we forge the high trust partnerships in those areas? Final point from me, Nicola talked about bringing businesses on board. And I remember as a politician, as a foreign secretary, doing a lot of work and trade delegations. In the end, the OEMs have got to come on board because, as you mentioned earlier, if their time cycles, their time horizons remain this short term, they're going to run into serious existential problems down the track. But Mackenzie do an annual survey on critical minerals and found that just 15% of OEM leaders will bear 10% premium for ESG grade minerals. And if that doesn't change, they're not brought into this public-private partnership. And we're seeing it with the Mountain Pass deal in the US. Apple were bought in. But can we see it in other public-private partnerships? Because if not, the short-termism that has frankly been a part of Western culture, whether it's government, whether it's shareholders, whether it's the media, but across the board, is going to be our undoing. So I think there is a real concentration span challenge for government, but also for business.
And interesting, Mark, so Dom mentioned an ESG premium, whether it exists, you know, the so-called green premium. Haven't really seen much of that. So customers will obviously say, yes, I want to have the most ESG friendly or ESG compliant material. I'm not prepared to pay for it. Do you think that applies to supply chain security? I'm prepared to pay more to have that security?
I think that's starting to be the dynamic in the market. There, you know, as the statistics tell, very few of the downstream consumers that we're dealing with are ready to pay a premium for a lower carbon footprint. But it starts with mapping the supply chain of carbon so you can distinguish between the attributes of different producers from one region to another and the carbon footprint associated with it. That mapping is beginning, and we're doing that across our 2,000 different suppliers around the globe. That's a very complicated exercise, but technology is aiding in the speed in which we can deliver that. I think with the awareness and the concern around carbon neutrality and some of the sophisticated markets that are forming, this will be something that industrial consumers will focus on. And in the case of Europe, they'll be forced to do it to comply with CBAM, which is coming on board. So I think there is regulatory oversight which can force that type of activity. But you know, I'll come back to the basic building blocks of competitive business. We need a competitive cost of capital that should be supplied by government initiatives if we want to compete with the low cost of capital around the world, which has been China historically. The Japanese and the Koreans, to an extent, have also done it. The West has failed miserably at providing capital for extractive industries or perhaps transformational industries, and we have to fix that if we're going to bring these solutions to bear. There finally is an awareness and a recognition that we need to create those associations, those partnerships along shared value chains. I think the example of what's happening, what His Excellency was talking about in Saudi Arabia is a perfect example. Long-term competitive capital availability, loan guarantees supported by the government, a supportive fiscal environment for permitting, land allocation, local workforce training and development, a good fiscal oversight for corporate stewardship in the areas. You know, if you bring all these pieces of the puzzle together, you're going to attract a lot of industry. You couple that with long-term cheap energy availability, byproducts for reductants, and we're going to build a project in Saudi because it's the most competitively priced region for offering all those attributes.
And Nicola, in terms of financing models and your lending book, do you factor in premia for ESG compliance? Do you allow for any sort of premia for supply chain security?
We are looking, is it now?
Yep.
Yeah,
We can hear you.
I think it goes. We are looking especially for partners who are interested in doing it in a sustainable manner. So example, when I'm speaking here with projects in Australia, and I see that on the ground there is no renewable energy for a very high energy intensive business, of course then we can bring along not only the technology for the renewables on the site, but also the financing, which is normally, and you were speaking about patient capital, which is a long-term financing in infrastructure. So for us it's not a problem to go for 20, 25 or 30 years loan with a stable interest rate. And this is also why it is often very interesting for our partners to go in such a stable situation. So we really try to implement new technologies, and this can be seen also with the innovation we see in the market with our startup portfolios when it comes to mining, when it comes to processing, refining, so that you really can improve in the process, and at the end also prove that it has not to have a premium or not a so high premium in the end. So for example, when it comes to renewables, under the condition that you have the grid to get the renewables from the production site to the plant, then the renewable is less expensive than the normal carbon fuels are. And so this is exactly the combination we are seeking for. And here we can go, whether this is on the corporate side, inside EU, outside EU, whether this is on the infrastructure side, working with the public hand, for example, so with governments who want to support infrastructure or corporates. So there is nothing, nearly nothing we cannot do and look in it. And it is often that we are developing the projects to bring them to bankability and then structure the financing, because we have not only bankers on board, we have over 600 scientists. So just had 3 new geologists, for example, employed by the bank, looking really in the technology, looking in the business case, not only on the numbers when it comes to financing, but also on the technology. And if we believe in a potential of a new technology, then we are happy to go for it, and then we are also standing there as a long-lasting partner with the patients, even with if the wind is blowing from before in your front.
Okay, thank you. Well, we're almost or probably out of time. So Massimo, if you had a magic wand, what works? What do you think will work in the future in terms of a model for cooperation?
Let's see if that still doesn't. Oh, it works now. I only have 10 seconds, so I don't know if I can do that.
Quick model.
What works is coming to a partnership with an open mind. I think there's still a lot of work that needs to be done in understanding the value chain and realizing that the value chain is complex. So oversimplification is often a big problem because it leads to a lack of understanding of the value chain. So the magic wand is let's go with an open mind into a partnership, and let's try and solve these common problems that we all have.
And then last but not least, as a representative of the host country, Demus, you've got 30 seconds to sell Australia to the world.
the geology is here, the mining and processing expertise is here. We have a reputation as a free trading, open economy based on market principles. Come and build a relationship along the supply chain so that we can work to mutual benefit. Mutual benefit, sustainable mining, but also sustainable processing, manufacture, and economies around the world. Very happy to engage and make that happen.
Okay, great. Well, we're out of time. Please join me in thanking all the panelists for their contribution. Thank you.